Hello and welcome back to the channel. If you're joining us for the first time, please consider hitting that subscribe button and ring the bell icon. This way, you'll stay updated with our daily insights designed to help you navigate the world of finance. Here are several types of insurance policies and how they can be used effectively in wealth protection and estate planning. 1. Life insurance. Term life insurance provides coverage for a specific period, such as 10, 20, or 30 years. It's ideal for meeting temporary needs, like covering a mortgage or funding college education for children. Whole life insurance offers coverage that lasts a lifetime and includes a cash value component that grows over time. This can be used as part of estate planning to provide a legacy for heirs or to cover estate taxes. Universal life insurance, similar to whole life, but with more flexibility in premium payments and the death benefit. The cash value grows based on a fixed interest rate or a market-based rate. 2. Disability insurance. Short-term disability covers a portion of your income for a short period, typically a few months to a year, if you are temporarily unable to work due to illness or injury. Long-term disability provide a percentage of your income if you are disabled for a longer period of time, usually until retirement age. This is critical to protecting your earning capacity and ensuring financial stability. 3. Long-term care insurance covers the costs of long-term care services, either in-home or at a care facility, which are not typically covered by health insurance or Medicare. This can protect your savings and assets from being depleted by high long-term care costs. 4. Critical illness insurance provides a lump sum payment if diagnosed with a specified critical illness such as cancer, heart attack, or stroke. This can be used to cover unexpected medical costs or compensate for loss of income during recovery. 5. Annuities, immediate annuities. You pay a lump sum in exchange for regular payments that start immediately and continue for life. This can provide a steady income stream for retirees. Deferred annuities. Payments are delayed until a future date. These can be used to grow investments on a tax-deferred basis and then provide income during retirement. Asset 5. Safe haven currencies. In times of economic uncertainty, stable and widely trusted currencies like the US dollar, Swiss franc, and Japanese yen become crucial safe havens for investors looking to protect and grow their wealth. These currencies are supported by strong, stable economies and are perceived globally as resilient in the face of financial turmoil. The US dollar, often considered the world's primary reserve currency, offers reliability due to the vast size and strength of the American economy. The Swiss franc benefits from Switzerland's political neutrality and its financial system's reputation for stability and security. Similarly, the Japanese yen is backed by Japan's significant global economic presence and its monetary policies that often support currency strength during global crises. Investing in these currencies can serve as a strategic defense mechanism against portfolio volatility and currency devaluation, providing a buffer that helps maintain the value of an investor's assets. Additionally, by incorporating these currencies into one's financial strategy, an investor not only protects their immediate financial interests, but also sets a foundation for enduring wealth that can support future generations. This approach ensures that personal financial legacies are not only preserved, but also have the potential to thrive and expand, even in challenging economic climate. Investing in stable and widely trusted currencies such as the US dollar, Swiss franc, and Japanese yen can be a prudent strategy to preserve and potentially increase your wealth during times of economic uncertainty. Here are some practical ways to invest in these safe haven currencies. 1. Foreign currency accounts. Open a foreign currency. savings or deposit account in one of these currencies at a bank that offers multi-currency accounts. This allows you to hold and manage money in a stable currency without needing to convert it back to your local currency immediately. 2. Currency exchange traded funds, ETFs. Invest in ETFs that track the performance of the currency. For example, US dollar ETFs such as the PowerShares DB US Dollar Index Bullish Fund, UUP, which tracks the dollar against a basket of 6 world currencies. Swiss franc ETFs such as the Currency Shares Swiss Franc Trust, FSF. Japanese yen ETFs such as the Currency Shares Japanese Yen Trust, FXY. 3. Forex trading. Engage in forex trading by buying and holding these currencies against weaker currencies or those expected to decline due to local economic issues. This is more speculative and requires a good understanding of forex markets. 4. Currency futures. Invest in futures contracts for the US dollar, Swiss franc, or Japanese yen. This method can be used for hedging against currency risk or speculating based on your expectations of currency movements. 5. Money market funds. Invest in money market funds denominated in these currencies. Such funds invest in short-term debt instruments and are a safer way to gain exposure to foreign currencies. 6. Bonds and debt instruments. Purchase government or corporate bonds issued in these currencies. For instance, U.S. Treasury bills, T-bills, are denominated in U.S. dollars and offer a secure investment. Asset 6. Art and collectibles. Investing in collectibles such as vintage cars, rare art pieces, handcrafted luxury handbags, limited edition watches, and first editions of iconic books offers a unique opportunity to not only diversify an investment portfolio, but also to safeguard and potentially increase your wealth. These tangible assets often appreciate in value over time, especially as they become rarer and demand increases among collectors. For instance, vintage cars can become coveted for their historical significance and aesthetic appeal. Rare art pieces can gain value as the reputation of the artist grows or as art historical importance is reassessed. Investing in collectibles like vintage cars, rare art pieces, handcrafted luxury handbags, limited edition watches, and first editions of iconic books can be a fascinating and potentially lucrative way to diversify an investment portfolio. However, it requires a blend of passion, knowledge, and strategy to be successful. Here are some examples and tips on how to invest in these niche markets. 1. Vintage cars. Research. Understand which models and years are most valuable and why. Collector car auctions and historical price data can provide insights. Storage and maintenance. Proper storage and regular maintenance are crucial to preserving the car's value. Purchase channels. Buy through reputable dealers or at well-known auctions to ensure authenticity. 2. Rare art pieces. Education. Learn about different art styles, periods, and artists. Knowledge is key in identifying potentially undervalued pieces. Provenance and authentication. Always verify the authenticity and legal ownership of the artwork. Insurance. Insure your investments as art can be highly valuable and susceptible to damage. 3. Handcrafted luxury handbags. Focus on iconic brands. Invest in brands known for their value retention, such as Hermès and Chanel. Condition and rarity. The condition of the bag and its rarity will significantly impact its value. Secondary markets. Luxury resale platforms can be good places to find deals and understand market prices. 4. Limited edition watches. Research limited runs. Watches that are produced in limited quantities typically retain or increase in value. Keep original packaging. Original packaging and documentation can enhance the value of collectible watches. Maintenance. Regular professional servicing is essential to maintain functionality and value. 5. First editions of iconic books. Condition. The value of first editions greatly depends on their condition. Mint or near-mint conditions are most desirable. Rarity and demand. Books that were limited in production or are highly sought after by collectors are typically the most valuable. Authenticity. Make sure the book is a genuine first edition by doing a literature search. Asset 7. Real estate. Owning property is a time-honored strategy for building and securing wealth, offering a dual advantage of capital appreciation and rental income. Real estate investment stands as one of the most effective ways to generate passive income while simultaneously increasing the asset's value over time. This enduring asset class typically appreciates in value, responding positively to improvements, developments in the area, and general economic growth. Rental properties provide a continuous source of income that can cover mortgage payments and operational costs, with the potential to yield surplus revenue. By strategically selecting properties, managing them effectively, and planning for long-term ownership, you can establish a robust financial foundation that supports your current lifestyle while also securing your family's financial future. This approach ensures that your wealth is not only preserved, but also has the potential to grow, providing a lasting legacy to be passed down through generations. Investing in real estate is a proven method to build wealth over time through capital appreciation and rental income. Here are several practical ways to invest in real estate, each offering different levels of involvement, risk, and potential return. 1. Residential properties. Buy and hold. Purchase residential properties such as single-family homes, apartments, or multifamily units and rent them out. This strategy provides monthly rental income, while the property ideally appreciates in value over time. Vacation rentals. Invest in properties in popular vacation destinations and rent them out short-term on platforms like Airbnb or VRBO. 2. Commercial real estate. Office buildings. Acquire office spaces in business districts with high demand. Long-term leases to businesses can provide stable rental income. Retail spaces. Invest in retail properties such as shopping centers or standalone stores. Retail leases often include a percentage of the retailer's sales, increasing potential income. 3. Industrial real estate. Warehouses and logistics centers. As e-commerce grows, so does the demand for storage and distribution centers. These properties can be rented to companies for use as warehouses or distribution centers. 4. Real estate investment trusts, REITs. For those who prefer not to directly manage properties, REITs offer a way to invest in real estate through the stock market. REITs own and operate income-producing real estate and are required to distribute at least 90% of their taxable income to shareholders annually. 5. Land development. Buy land. Purchase undeveloped land in the path of growth and hold it for resale as the area develops. Or develop the land yourself by building residential or commercial buildings. 6. Real estate crowdfunding. Participate in real estate investments through crowdfunding platforms, which allow you to invest smaller amounts of money in larger projects, like commercial developments or large residential complexes. Stay now with the 7 key takeaways. Why you should not keep your cash in the bank. 7 hidden assets that will explode your wealth. See you there.